Welcome back. So we're gearing up for what promises to be a bit of a challenging start. Asian markets, like we've been telling you, are down, some of them as much as 2.5%. That's the Hang Seng. So what about India in the midst of this global tariff storm? Matt Orton, Chief Market Strategist at Raymond James Investment, is with us in person this morning in the studios. Matt, how good to see you in person.
It's wonderful to see you.
Thank you for coming in. Never a dull moment. So last week we were discussing what are the options on the table, even if the courts try to stall Mr. Donald Trump. And I think he's looking to exercise some of them. So what are you expecting near term? More volatility, but is it still a buy on dips opportunity?
I think so. I'm still quite constructive on where the market goes because we've been able to continually scale this wall of worry. There's been a lot of uncertainty. I'd say this has been one of the most hated rallies that we've had in a very, very long time. And whenever you see a lot of this tariff news come, we know there's going to be tariff uncertainty, but the market is recalibrating to that uncertainty. And when you have a backdrop of really, really strong earnings, good fundamentals, a strong job market in the U.S., and the rest of the world almost bottoming and starting to reaccelerate from an earnings perspective, I think that sets up a really good fundamental backdrop for a rally to continue. So I continue to tell clients, use downside opportunistically, but don't chase the upside because we're going to see a lot of fits and starts to this rally.
Matt, the U.S., what's the view? The consensus still seems to be that maybe money will keep coming out of the U.S. and go into other parts of the world. Would you agree with that? And it's not a sprint, it's a marathon in that sense. What is your reading?
Yeah, Prashant, I think that's a good point. It's definitely not a sprint. And I think where you're most likely to see some recalibration with respect to money coming out of the U.S. is going to be from European institutional investors. So there's been this huge to-do about sell America. And I don't think there's been actually a lot of truth to that. But when you look at European institutional equity investors, they've been very overweight to the U.S. for a long time. And while I don't expect them to sell tremendously from some of their big holdings, the mega cap technology names, I do think there's the possibility for, say, a 1, 2, 3% at the margin change to repatriating those assets back home, especially if some of these tax bills are passed that's tied up in this big, beautiful bill. If that happens and you see that money start to move, that can have a very tangible impact on European equity markets. So that's an area of the world I'm also more constructive on, especially when you overlay that with better fundamentals and a lot more fiscal spending coming from their governments to support stocks.
All right. Hey, Matt, good to have you in the studio, Matt. And you're one of those that I've heard over the last many months who's been very bullish on Indian equities. So where do we stand right now? We have had a good run. I recall when we dipped as well, you said you would be looking to allocate more money. So what do you think? Going by the current valuations, going by the domestic positives that I just highlighted, are you still constructive on Indian equities? And give us a couple of stocks as well. The last time I think you mentioned Jio Financial and Paytm. Anything new?
Yeah, great point, Nigel. I'm still constructive on the Indian markets. I think we might enter more of a consolidation period right now, which is healthy. We've had a 15% rally or so from the bottoms a couple months ago. So that's a really good setup for the markets to maybe take a breather. And as long as you continue to see shallow dips followed by better buying activity, that to me looks attractive. And then you overlay the fundamental picture where you have some of the strongest GDP growth around the rest of the world. That's a really good opportunity with a weaker dollar for money to start moving back into the country. So I have been active on buying some of the dips. My core holdings still remain the same. I still very much like some of the financial names like ICICI Bank, Mahindra on the auto side. But I have been looking more at some of these secular growth trends. How is artificial intelligence being integrated into businesses? How are people leveraging, I'll call it, new consumerism, new trends? Those are global themes that I think are playing out in India. So Paytm is one of those names I like a lot. I think investors think the name's fairly expensive, which it is, but if it can realize some of its growth, I think there's a long runway for further recovery. Some of the names I'm looking at as well that I'm here for the Bank of America conference that I'll be talking to management teams, infrastructure names like L&T, that one looks interesting. There's been a strong recovery. I've been enthusiastic about their earnings and CapEx and also where they're seeing investments across the GCC. So I think that can be another area of opportunity. And then also looking on the infrastructure side, like in Adani Ports, that name's had a pretty solid recovery. And when I look at the actual fundamentals, earnings have been ticking up. Some of the acquisitions I would expect to be fairly accretive to their bottom line relatively quickly. So I think there's a lot of room to run there as well. So there's definitely opportunities in Indian equities. Again, same as the U.S., don't chase the upside. wait for that consolidation because there will be opportunities, and these are good long-term trends guiding these names.
Quite interesting. Matt, also, I mean, this week we have the RBI policy, and the broad expectation is that they'll cut rates, and some people say they could cut up to 75 basis points, 100 basis points over the next 12 months, right? You've already liked large Indian banks in the past. How would you look to play this easing cycle in India?
Yeah, this is where selectivity becomes really important because rates coming down could pressure net interest margins for some of the banks. So when you look at a bank like an ICICI, they not only, I think, have strength with respect to their ability to navigate net interest margins based on their loan books and how their deposits are coming in, but they also have a growing private banking business that is higher margin that can offset perhaps some of the weakness you would have from net interest margins. So I like companies that have, I'll say, that balance of exposure and growth to a burgeoning, I'll call it an investor class in India. That's really, really exciting, and you don't have that in a lot of other markets around the world. So that's how I look at the financial landscape right now.
Still liking the big banks like ICICI?
I do. That and HDFC, those are two of my favorites right now.
Okay. Well, fantastic, James. Thank you very much. Great conversation with you, and we hope you have a great stay in India. Come back, with lots of ideas, and of course we'll keep chatting you once you're done with your management meeting.
Maybe after you do all the conference rounds, we can have you back to get a sense of,
I'll catch you at the conference itself.
Absolutely. I think that would be great.
Thank you very much, Matt.
Thank you.